Hi, this is James Shug with Westpac London's end of day report for Thursday, July the 11th. Well, there wasn't too much economic data today. Really, it was all about ongoing reaction to the Fed Chairman Bernanke's comments he made in a speech last night. These comments were made after the release of the minutes to the June 19 meeting. Those minutes showed about half of the committee favouring a fairly prompt start to the tapering of Fed asset purchases. And that's been a focus of the markets, of course, for a couple of months now. But it's almost as if Bernanke's been reading Westpac's research, our July monthly, where we expressed some concern that it was not really appropriate or not the right time yet, that the case had not yet been made for the Fed to ease back in policy accommodation. And Bernanke's been thinking, those guys at Westpac are right yet again, because he seems to have backtracked a little bit. He's now talking about markets shouldn't confuse a shift in the mix of Fed accommodative policies with an actual unwind of the degree of policy accommodation. He went to some pains to distinguish the prospect of interest rate rises from any tapering of asset purchases, and said pretty explicitly that the case wasn't yet made in terms of the economic data reaching the Fed forecasts for next year. So markets have taken that to mean that an unwind of the Fed's asset purchases, or a pullback at least in the amount they're purchasing, currently 85 billion a month. It's no longer a done deal that it's going to happen as soon as the September meeting, and that's seen risk assets benefit across the board. We had weekly unemployment insurance claims in the US. They rose 16,000 to 360,000 in the first week of July. But you just write off claims in July. We get auto plant shutdowns for the new model retooling. We had the July 4 holiday, and that makes seasonally adjusting weekly data pretty much impossible. And so the numbers will bounce around a bit, and we'll revisit them in August. Import prices fell for the fourth month running in June in the US. In Europe, oh God, where to start? I mean, politics is really back in the frame there. Not all of these things I'm going to run through are today, but they nevertheless add up to a real potential firecracker in terms of reigniting the sovereign debt crisis. So the Portuguese president has rejected the rejigged coalition that Prime Minister Peter Rabbit pulled together. What the president is saying is that the coalition and the socialist opposition should form an administration to agree on ongoing austerity measures, and then have early elections. The corruption scandal in Spain seems to be circling Prime Minister Rajoy even more intensely, adding to his unpopularity, given that he's been implementing pretty harsh measures, austerity measures that is, often in total contrast or conflict with or breach of election commitments he made a couple of years ago. Italian politicians have responded in all sorts of bizarre ways to the downgrade by S&P. So Italy is now just 2 notches above junk. Spain's 1 notch above junk. We estimate well over €1 trillion worth of bonds of those governments are held outside the borders of those countries, and to the extent that pension funds and what have you track indices and wanted to benefit from the sharp fall in yields that we saw after OMTs were announced and the Fed announced QE 3 and 4, there's a lot of investors that might be pretty close to wanting to run through the exit door and get out of those trades while they're still profitable. So any wobbles in Spain or Italy need to be watched very carefully. In Greece, we've got what we've now called the sack for cash bailout, where basically Greece has to sack public sector workers or put in place more spending cuts, and then in dribs and drabs the bailout funds will be passed on to them. That's just going to make the already fragile administration there even more prone to falling apart. And we all recall, of course, last year the turmoil surrounding the initial election in May and the follow-up election in June. In Luxembourg, the government there has pretty much fallen on its sword following a spying-related scandal. Elections were due to be held there next May. It looks like they could be held as early as October of this year. Now, we've got elections in September in Germany, of course, and Chancellor Merkel, quite bravely I think, is throwing the word debt restructure around in the context of Greece, and in some reports it's actually right down. Maybe testing the water to see just how unpalatable it would be to be a little bit more lenient towards Greece for the umpteenth time. So all of that has the potential to refocus attention on the many fault lines running through the Eurozone, and I thought I'd just use the opportunity today to run through some of them. Oh, and France, of course. Hollande's is under a lot of pressure from the business sector for relying too much on taxes rather than spending cuts in terms of trying to get the French fiscal books in order. Hollande has done a bit on the labour market to reform the economy, but we're hearing almost every week that countries like Spain are actually more competitive than France now. I mean, the boss of Peugeot said earlier this year that their most competitive manufacturing facility is now in Spain. Opel have recently expanded their capacity in Spain. So, you know, there are benefits that accrue to all these measures that bring with them short-term hardship. France is yet to go through that pain. If they don't, they won't be able to survive in the single currency. And when markets realise that, it won't just be the likes of Italy and Spain that are worrying about their ratings. So, that's it for the news today. In terms of markets, just ahead of the London close, we've closed. So, the FTSE up 0.6%, the French market up 0.75%, the German's up 1.1%, and the Spanish market up about 0.5% today. The Dow's up about 1% New York lunchtime. And as I say, it's pretty much all down to renewed hope on the part of investors that the Fed won't be winding back on its asset purchases just yet. In commodity markets, we've got copper prices up almost 3% today, gold the same, almost 3% at $1,281 an ounce. And oil prices, though, they're down 1.5% at $104.89 a barrel. The Aussie dollar, well, it had a good session last night, traded as high as 93 cents, but it's back down to 91.4 against the US dollar at the moment. The rising unemployment rate in Australia and a lot of press about the likelihood of another interest rate before too long, possibly August, which is our view. That's put a bit of pressure downwards on the Aussie. All right, that's it for today, and I'll be back tomorrow.